Hey guys, welcome back to our three-part series all about how to read and analyze financial statements. Today is part 2 where we are going to be diving into the balance sheet. My name is Danae Wolf. I am a financial clarity coach and a profit strategist, which means that I help entrepreneurs like you increase your profits and decrease your stress through financial education. I believe that if you don't know what's going on in your bank account, you don't know what's going on in your business. And I really, in my bones, guys, believe that financial literacy can change your life. I'm living proof of it. And my entire goal here on my tiny corner of the internet is to help you guys gain the knowledge and information that you need to start taking control over the money in your business and stop letting it control you. Now, when we talk about being financially literate, one of the cornerstones of that is knowing how to read and interpret financial statements. Financial statements tell the story of your business. They are completely imperative to the success and profitability of your company. But the truth is, they can be overwhelming, right? So, we are going to tackle the second report in our series, the balance sheet, today. Now, last week we went over the profit and loss statement, and you guys can see that. I'll link it below. But if you head over to YouTube and do a search for Danae Wolf, Deni, last name Wolfe, you'll be able to find the three-part series there. I definitely recommend you watch all three videos. We're going to be talking about the big three: the balance sheet, the cash flow, and the profit and loss. And today's training is all about how to read and analyze your balance sheet. So in this video, you guys are going to learn what the heck a balance sheet is, what the balance sheet equation is, and why it matters to you. So a balance sheet is a financial report that shows what you own, what you owe, and your ownership interest in your company. Now, just making it very simple, because this is how I believe things need to be spoken about. I think a lot of times when we watch other accountants do trainings, they use words that can be overwhelming, right? So I love analogies. So here is how I look at the balance sheet, right? So the balance sheet is going to show us what we own, what we owe, and what our equity is, right? Think about it in terms of your house, all right? We've got what we own. Think of that as the value of your home. So pretend you got what is it called? An appraisal, right? Think of that as what you own, the value of the home. Then the next part of the balance sheet, right, is what you owe. Well, think about that as the balance owed on your mortgage. And then what do we have left? Equity, right? So this is an equation that I think all of us firmly understand when it comes to owning our homes, right? We understand the value of our home minus what we owe on our mortgage equals our equity in our home. Guys, that's how it works in your business. And that's what you get from the balance sheet. Now, I hope that was an aha moment for you guys, because for me, when I was starting my entrepreneurial accounting journey, that is what made it all click, because I was finally able to say, oh, that's what the hell the balance sheet is showing me. When I started thinking, all right, house value minus what I owe on my mortgage is the equity I have in my home. Boom. There you have it. So let me know in the comments if that actually helped you, because for me, like I said, it was a light bulb moment. So that's what your balance sheet's going to show you guys, right? What you own, what you owe, and what your equity is. Now, the actual balance sheet equation is assets equals liabilities and your equity. And you want to make sure that that's always balancing. And this is something that I'm going to tell you guys. Typically, if I step into a situation where an entrepreneur is doing their own books, and let's say they have a pretty firm grasp on how to do their weekly bookkeeping, I would say I'm going to go as aggressive as saying about 95% of the time, the balance sheet is usually done wrong. So I do think that you want to make sure that you're getting some type of professional help and guidance when you are structuring your balance sheet and just making sure that it's actually balancing and everything is making sense. But let's dive into this. Okay. So we've got the equation right here: assets equals liabilities and equity. So let's break down each of these. So very simple, guys. An asset is what you own, okay? A liability is what you owe. Now, when we look at the balance sheet, and don't worry, at the end of the video, I'm going to give you guys a visual and walk you through an actual balance sheet. And what you're going to see is that our assets, what we own, and our liabilities, what we owe, are categorized as long-term versus current. And I want to just very quickly explain what that means. When you see a long-term liability or asset, it simply means that it has an expected life of more than 1 year. So let's see as an example, right? Let's say that you have a business loan, right? So that's something you owe. So that would be a liability. And let's say it's a 5-year term. That's going to be considered long term because it's more than 1 year. Now, let's say you have a long-term asset, right? An asset is something you own. It's something that you purchased for your company that you believe is going to help you generate revenue for years to come. So as an example, maybe you bought a vehicle for your business, right? So something like that is going to be considered long-term because you're obviously going to use a vehicle for more than 1 year. But when you take a look at your current assets and current liabilities, these are all things that are expected to be used in less than a year. So as an example, if you owe sales tax, right? Any sales tax you collect from your customers that you are going to owe is going to sit on your balance sheet as a current liability because that money is going to be owed within the year. But a business loan that has a bigger term than 1 year, that's going to go to your long-term liability. A current asset is something that you're going to be utilizing within 1 year, right? So our cash is something we own, right? That's going to be in our current assets, not our long-term fixed assets, okay? So again, very simple. When we're seeing a current, they mean something that is going to be within a year, used and turned and converted into cash. And then our long-term is going to be more than 1 year. So very simple rule of thumb to understand there. Then the third component, right? We talked about what an asset is, what you own, what a liability is, what you owe, and then equity. So the equity in the balance sheet, your owner's equity in your business, is the combination of your owner's contribution and your owner's draw. So as you put money in and as you put money out, right, that all is going to contribute into your owner's equity. So maybe you put $50,000 into your business, but maybe you took $60,000 out, right? So you're up. But what if those numbers were reversed, right? You've put more into your business than your business has given you. So owner's equity is a really important piece, right? Because we are supposed to be getting paid from our businesses. We're not supposed to be paying our businesses. But we all know, we've all been there. We've had that entrepreneurial struggle where we can't make expenses and we have to make a transfer from our personal checking account into our business. So we need this section of the balance sheet to track that for us so we can see what is our equity, right? What's the owner's equity? Are we up or are we down? I love that section. And it's something that you guys want to make sure you are looking at because if you are in a situation where maybe you have some cash flow problems, and yes, a profitable business can be cash flow negative, and we are going to get into that in the third part of the series, all about the cash flow report. But if you are having cash flow problems and you find yourself in a situation where you keep having to put money into your business checking account, we have to make sure we track all of that right in that owner's equity so we know ultimately Did I put money in to float the business and get it back and then some? Or does the business still owe me money? So love that part of the report. You will also see on a balance sheet AR and AP. AR is accounts receivable. It's money that is owed to you. All right. And then AP is money you owe, accounts payable. This balance sheet is taking what we have on the P&L, right? The P&L are the transactions, how they were categorized, and what happened in the last month, last week, whatever you pull those dates for, right? And think about it, I'm going to go back to an analogy. Think about it as the profit and loss would be you really looking at your last month personally. What was your mortgage? What was your utilities? What did you spend when you went out to dinner, right? So think of your personal budget analysis. All of the expenses and bills that you paid, that's your P&L. So if you sat down personally and thought about your mortgage, your grocery bills, your kids' tuition, all the money that came into your business and went out of your business, that would be your P&L. But the balance sheet is that high level picture. That is when on a personal level, right? You would be looking at your net worth. So think about it as one of them is the monthly budgets, what's going in and out of your household, right? Then let's say when you go to buy a new house, you guys have probably had to do this, right? You've had to deal with your net worth calculation, right? And that's that higher level piece of, okay, well, what are your assets? And they'll usually ask things as mundane of, do you have jewelry worth anything, artwork worth anything? Do you have vehicles, right? What do you owe on those vehicles? That personal net worth worksheet that I'm sure you have encountered if you've ever applied for any type of a loan or a mortgage, that is the balance sheet. Whereas the P&L would be, and again, I'm using the analogy of you guys looking at this through the personal lens. And tell me if this is helpful, because for me, these were big aha moments, right? When I was able to break it down and say, okay, what does it look like when I try to do these exercises personally? So my P&L is my regular income expenses in my personal household. Think about it like that. And then the balance sheet is, if you are looking at it from a personal perspective, calculating your net worth. The balance sheet is calculating the worth of the business. All right. So keep that in mind as we go through it, because you want to realize the importance of the balance sheet. Let's say we go through and analyze all of our profit and loss statements, and we see that we made $100,000 last year in profit. And we're like, woohoo, right? Celebrating. Yes. Then we go to the balance sheet and we see that the business is $1 million in debt. That just deflated you a little bit, right? That balance sheet shows that extra component. That shows that snapshot view of the full financial picture. Your P&L is giving you the ins and outs of the money that happened last month, but your balance sheet is telling you, here is your full financial picture. So again, using the analogy to think personally, right? You might be in a situation where by the time you get your paycheck and pay all your bills, maybe you have $5,000 left at the end of the month and you think, great, I'm flush with cash. But then we go and look at your net worth statement and we see you're hundreds of $1,000s in debt. You have a bunch of credit cards out. No, that's not a good total picture, right? So this balance sheet gives us the total picture, because if we are profitable, great, always want you to be profitable. But if we've got a business that has a ton of debt on it, that's going to suck out a lot of cash flow, right? So we use the balance sheet to really say, what is the value of the business? Because if the business is profitable, sitting on a crap ton of debt, we're going to have a problem. And this is a little bit more complex, but I can also tell you the profit and loss, whether you pulled it based on your cash or whether you pulled it based on accrual, right? We might look at the balance sheet and say, hey, there is a ton of money in AR. What is AR, right? Money owed to you. So maybe you're profitable, but that's because your P&L is saying, well, you should be profitable if the people pay you. The balance sheet is going to tell you if these people didn't pay you. So again, super important for you to know. We do not want to just, fly by the seat of our pants when it comes to our company, right? Money is why you started this, right? Money is not a dirty word. You have to have your shit in place. You need to be financially literate and know what is going on. You don't want to be that person pulling a P&L and saying, oh, great, I'm profitable, but then not looking at the balance sheet and realizing, oh my gosh, I am in so much debt, because that's going to come back to bite you in the ass. So you want to look at the full picture, okay? And let me just give you another analogy, all right? Think about it like this. I'm talking to you ladies now. Let's say you meet a guy, he's got a flashy car, he's got a nice house, and he seems to be flushed with cash, right? Every month he takes you out, you do all these things. And now you decide to get engaged to that guy, and you finally sit down to look at finances, and you discover he's got hundreds of $1,000s in debt. That piece of the picture probably is not going to sit well with you, right? We got to look at the balance sheet to see the full picture. So I'm going to go ahead and share the screen and walk you guys through an example. Now, full disclaimer, this is a QuickBooks Online demo account, so I don't want you guys to think that I am sharing somebody else's balance sheet with you, because I am not. This is fully allowed. This is why QuickBooks has demo accounts. So you can see this balance sheet is for our fictitious company, Craig's Design and Landscaping Services. So the way that it's set up is the balance sheet is going to show our assets, and then the next section is going to show our liabilities and our equity. Because if you remember, our equation is assets equals liabilities and equity. So let's walk through how this all looks. So first, in our assets, we've got our current assets. Remember, those are things that can be converted to cash quickly within a year. We've got all of the bank accounts, right? Those are current assets. Obviously, that's already cash sitting there, right? So this is something we own that we're able to convert to cash within a year. The cash in the bank is already cash. So obviously, that's going to be our current asset. Then we have accounts receivable. Remember, we talked about that. That is the money owed to you, money that your customers owe you. So a common example for this would be maybe you sent out invoices, right? And people just haven't clicked to the link and paid you yet. So that's going to be sitting here. This is money owed to you. And because the due date is within the year, it belongs in current assets. Now, if you had some type, I can't think of anything that this would apply to, but if you had some type of business model where your customers paid you 2-3 years from now, that would be a long-term asset. But this is considered current because, fingers crossed, your clients are paying you within a year. Then we've got our other current assets. So in this situation, this here is listed in this demo account as some inventory and undeposited funds. So inventory would be if you are a product-based business. So maybe you're a hair salon and you've got a bunch of products that you sell in your store. So the item sitting in stock, right, that you just haven't sold yet, that's an asset, because again, the hope is that we can convert those to cash by selling them within a year. Now, undeposited funds is a section in QuickBooks Online. What it really means in its most simplistic terms is that this $2,000 has been paid, which means your customer has either mailed the check or swiped their credit card, but you're simply waiting on the cash to actually hit the bank. So in our accounts receivable, these are customers who have not paid but have been sent their bill. Undeposited funds are customers who have paid, but the cash is in transit. So think of it as when you check your shipping in Amazon, right? It's in transit. It's on its way. But the AR people, that shit's not even on its way. All right. You're still waiting. Now let's move on to our fixed assets, right? So fixed assets are investments we've made in our company that we believe are going to generate revenue for years to come. So if you are a cleaning company and you buy, I'm going to butcher this name, but what is it called? Like a stigmatic cleaner, like sanitizer thing, like that big bulky piece of equipment that was very popular during the COVID in 2020, the COVID pandemic in 2020. People were buying these electromagnetic steamer things that they were a couple $1,000s, right? But the idea is that we're going to keep using that and generating more and more revenue. If you are a mobile dog groomer and you purchase a second vehicle, to do your mobile dog groomings, right? That is a fixed asset because that is something that you own that you're hoping is going to generate revenue, because hopefully with buying the second truck and getting another dog groomer in there, you are going to get on additional clients and it's going to be generating revenue. So our fixed assets are things we own. That is something we made an investment in our business that we hope is going to generate revenue. Then we come down to our liabilities. Now, remember, our current liabilities are bills we have to pay this year. Our long-term liabilities are bills that we don't have to pay within 1 year. So, accounts payable, this is anything that you have entered into QuickBooks Online as a bill. So, I want to be clear, this report will not give you a true snapshot of your accounts payable if you haven't entered in your bills. All right. So don't log into it and say, oh, I owe nothing. Well, if you didn't enter them, then of course it's going to say you don't owe anything. But if you've entered your bills, then your accounts payable is going to be accurate. You can also see that we've got our credit cards on here, right? Because those are obviously liabilities that we want to make sure that we're paying off. Hopefully you're paying them off in real time, so it's considered a current asset and you're not keeping the balance for, multiple of years. Then we've got revenue payable, right? Arizona Department of Revenue payable in this example. These are taxes, right? So typically a sales tax or anything like that. Again, all liabilities that you owe within a year. Then we get to our long term. This is more than 1 year. So in this example, this is a notes payable, another word for a loan. So this is obviously a loan that is long term, that is going to be owed more than 1 year. So you can see we've got all of the assets on here, and then we just went through all of our liabilities, and now we are going to look at our equity. Okay, so our equity is showing us here opening balance equity, right? So what did the owner contribute? What did the owner put in? Retained earnings. What did the owner take out? Net income. Okay, so this all is going to add together to give you your total equity. Well, you put in this example, the fictitious business owner in this demo account put in way more than they took out, right? So they're still at a negative. They've got to get paid another about $7,700 just to break even with the money that they've put into their business. So this is a powerful number to know, right? Is it costing you money to be in business? Is your business paying you, or are you paying your business? It all lives on the balance sheet. And this is that full picture that we want to see. And I'm going to go ahead and come full screen real quick because I just really want to hammer this point down. I see amazing profit and loss statements all the time. And you initially get that gut, reaction of this is great, this is great. And then I go to the balance sheet and I'm like, ooh, this is not so great, right? So while it's wonderful to be profitable, that's great. Want a profitable business at all times. The full picture, it's what we see on the balance sheet. So if your business is profitable, but you're still having a ton of debt, you're still having to put money into your business and you haven't even recouped your investments that you've made in your business. If you're putting $5,000 into your business every month and only taking $3,000 out, you're still in the hole 2,000. You get that information from your balance sheet. So let's head back into here and you're able to see we've got our assets and our liabilities and our equity. And you can see they equal the same amount. You always want them to balance because that is our accounting equation, right? Assets equal liabilities plus equity. Think about it like this, right? Going back to the house, your equity in your business, right? That's going to be that net effect of what you've put in and what you've taken out. So just like looking at our house, what's the value of our home? What do we still owe on the mortgage? And what's the equity we have left that we could take out? So I think that it's super important for you to first just realize these reports are not really user friendly, right? So let's just acknowledge that. Let's just take a deep breath and acknowledge that and realize that practice equals progress, right? So I'm not expecting you guys to watch this and be like, boom, I know what a balance sheet is. I am, fingers crossed, hoping you watched it and you had some light bulbs go off and you're walking away saying, I have a much better understanding of it. But I am hoping that you walk away from this realizing, hey, the balance sheet is important and I need to start studying mine. I need to make sure mine is accurate and I need to start learning what it's telling me about my business. Your balance sheet is giving you the full picture, honey. You want to know how much debt you have. You want to know what your equity is in your business. How much have you given the company and what have they done to pay you back? You need to see these things. You need to know what all of your assets are. If you wanted to start selling things tomorrow, what are you able to sell? What are those assets that you could easily convert into cash? So much information is there. But here's what I don't want you to do. I don't want you to just turn this video off and say, okay, that's too confusing. I'm done. No. Okay. You are too much of a badass to just turn this off and be like, I'm done. I'm not dealing with the balance sheet. No, that's not how we deal with our problems. We're going to face them head on. And if you guys have questions, if there are still things that are blurry, please shoot me a DM. You can find me on Instagram at the Chic CFO, THECHIC CFO. Shoot me a DM. I am happy to go back and forth with you and answer any questions you have because the balance sheet is part of the big three. It is super important you know how to read and analyze it like a CFO because you might be the CEO of your company, but if you haven't hired somebody like me, then you're also the CFO because the CFO is the one who keeps the lights on. Money makes the world go round, and you have to learn how to make it and keep it. And the truth is, making it is the easy part. It's keeping it that can be difficult. And the way you keep it is to have a solid foundation of financial education. I will see you guys in the third part to this series, which is all about the cash flow report. If you enjoyed this video, please let me know in the comments because the more engagement we can have, the more the algorithms will share this video with other entrepreneurs so it can benefit.